Hello and welcome to Connected With Latham, where we discuss ideas, legal developments and business trends shaping the global economy. I'm Mike Turner, a corporate and emerging companies partner in Latham & Watkins' London office. In this episode today, we'll discuss how startups and scale-ups can prepare for an IPO. This episode is aimed particularly at founders and early-stage investors in fast-growth technology and life sciences companies across Europe. I'm delighted to say that I'm joined today by John Watkins, managing partner at Altima. Over the last 2 decades, John has helped some of the world's most successful startups build their senior finance leadership to accelerate their growth. Thank you for joining me today, John.
Great to be here, Mike, and looking forward to the conversation.
Now, you and I have been working in this emerging companies space for many, many years, but the dynamics we saw in 2020 and arguably even more so to date in 2021 are in many ways completely new. So let's drill down into that a little bit if we may. From what has changed, what is most impacting what you're seeing in the markets, particularly as a result of the ever-compressing and compressed funding and exit timelines we're seeing?
Yeah, there's specifically in terms of our market and what we do, and naturally advising early to growth stage companies on their finance leadership. The biggest trend we've seen is essentially actually that Series A companies are now hiring what we would describe as proper CFOs. So traditionally, what a big inflection point for us as a firm would be Series B. So we'd see companies that have maybe raised $30-40 million in a pre-2020 Series B that maybe would have taken 2 years to get to that point post their A, that would be looking to press the button on their first genuinely senior CFO that could potentially lead the company through a Series C, a Series D, and hopefully under some form of whether exit via an LBO or via an IPO. What we're seeing now is that because of the nature of funding is changing, we're seeing that rounds are, they're getting larger earlier, and also the timeframes between a Series A and a B, certainly over the last 18 months or so, feels that it's becoming significantly compressed. This means that a company at Series A now is actually sometimes even pre-A, is in the market for a genuine CFO that could take that business through substantive and successive funding rounds. And simply because the companies that 2 years ago would raise a Series A, they'd often be still relatively nascent. They'd have obviously a great tech product built, and they'd have often a rev function built, so over-indexing on product and go-to-market. And the CFO seat would often come much later, so they make do with the head of finance, etc., because that company may have raised $5 to $10 million. We're now seeing Series A companies raising $30-40 million. And suddenly what that CFO needs to deliver, or what that company needs to deliver with a CFO, is resource allocation in businesses that often will have a big disconnect between their revenue profile and their funding profile. So there's a greater demand across the market for seasoned CFOs, actually from a much wider spectrum of companies across the life cycle. So one of the biggest impacts we've seen simply is a big change in the supply-demand economics of our particular marketplace of bringing CFOs in. And so you will find situations now that it's not unusual for a Series D company to be talking to a CFO, and that CFO is actually also talking to a Series A company, which frankly 2 years ago would have been unthinkable. But also it doesn't, so the net is that, I think founders and funds alike at Series A, they have an opportunity now to bring in a game-changing CFO, simply because actually there's a reality that company could be looking at a $50, $60, $70 million Series B within 6 months of their Series A, that we've seen over the last 12 months or so. So there's been a big impact on the market in terms of supply and demand is the thing that we've seen. And I mean, what about yourself? I guess the evolution of the fundraising, how's it affecting the advice that you're giving and the counsel you're giving to founders and funds?
Yeah, it's very much as you suggest, that I think the dramatic acceleration in the timelines is what is causing the most challenge and opportunity for founders and growing tech companies. So what we saw in 2020 was a staggering acceleration of the adoption of both enterprise and consumer technologies, which coincided with an absolute wall of private capital becoming available for investment in the market. And I think institutional investors finally got the joke about the value of the tech sector and the life sciences sectors. And we have these two different dynamics of vastly accelerating consumer and business demands and a wall of capital to support the rapid acceleration that the markets are demanding. That is compressing timelines, and it's meaning that companies are having to grow up in much more of a hurry, I think, than they ever have. And one of the dynamics that has given rise to is what we're really here to talk about today, which is the fact that companies are having to think about the IPO story a lot earlier than perhaps they ever have. And I know that is dramatically impacting what you have to think about as well, John. So turning to that subject of getting prepared for IPO, or even that large pre-IPO funding rounds, because we're now seeing funding rounds of several $100 million, or an M&A event, or dare I say it, even a D-SPAC, what does a right-sized company look like from your point of view at each stage of that thought process? And a particularly important question for me is, in such a rapidly developing market, how do you find people with the relevant experience, and how important is experience per se?
Yeah, quite literally actually is the billion-dollar question that we get asked by founders and funds alike. And as we alluded to earlier, companies are definitely hiring more seasoned, more experienced, more market ready and transaction ready CFOs at a much earlier point in their life cycle. The big question we get asked a lot and advise upon is, do I need to find a CFO that can lead an IPO, that can be involved in a SPAC merger, but someone who really understands public markets? Do I need an IPO ready CFO? And it's an interesting question because, frankly, the market dynamics are pretty out of kilter. When you alluded to earlier the wall of capital which is out there, whether it be in the form of SPACs, in the forms of growth equity, in the forms of pre-IPO financing that I'm sure we'll come on to in a little while, but there's a huge amount of capital which is driving a huge amount of growth, which drives a huge amount of demand for people who've done this journey before. But the reality is there's still precious few CFOs that have led multi-billion-dollar IPOs within Europe, certainly in compared to demand. So absolutely, if you can find that literal unicorn that has led to IPOs before in European markets, then obviously that would be an ideal fit. But the reality is that there aren't that many of them out there. So for us, the way we think about it actually is and we always advise founders that no CFO will ever have more support around a transaction in their career than an IPO. There's so many entities with vested interests, whether that be the later stage investors, whether that be bankers, whether that be lawyers like yourself, no doubt, and in terms of accountants, etc., that there's a huge mechanism and framework that sits around that transaction. So for us, actually, I think when we think about the CFO seat and what someone needs to get through an IPO, they still need phenomenal financial rigor. A company still needs to get through audits. A company still needs great governance. A company still needs a trajectory of strong financial performance to help it be successful in the markets. So I think for us, great CFOs are great CFOs, and it comes then to thinking about how you support that CFO through any particular transaction. And I think for us, this is where there's two aspects: the board and how you support that CFO with hiring. In terms of the board, I think this is where there's a real opportunity for companies at a relatively earlier stage than maybe many do now to bring in a seasoned non-exec who's maybe been a CFO in a public markets, that understands the nuances and actually the differences between a public markets company and what public market investors want to see in a company in terms of performance versus growth equity investors and venture investors. And again, if we take a step back and think about, we've accepted that there's massive acceleration in terms of fundraising. There's acceleration in terms of growth because of all those underlying trends. That we're seeing companies that have got huge profiles of burning cash that are thinking of coming to market. So being a CFO in a company that's growing at several 100% a year with a massive cash burn and really thinking about fueling growth versus being a public company CFO are two very different things. So for us, I think rather than really looking for that unicorn of CFO that's been through that journey and has taken a company public, I think supporting a great growth company CFO with a really seasoned non-exec who can look after Remco, who can look after the audit committee, is a really elegant solution. The other piece, of course, is the team around them. So depending on that CFO's background, and we've worked with companies and we've put CFOs into great businesses that have either come from a technical financial place, so a chief accounting officer that moves to a CFO. We see that a lot in the Bay Area, for example, but also the profile of the ex-investment banker. And those two archetypes will bring two very different lenses and flavors, if you like, to the CFO seat. And it then becomes about how you support them with hires. And in that first instance, there's always the devil in the detail of an IPO, of SOX compliance, of IFRS, and it's not the sexy end of finance, right? But it's certainly the keeping you out of jail end of finance. So it's a really important piece as you go through a transaction such as an IPO. If your CFOs come from that background, it may be that you support them with a really strong head of IR who's an ex-capital markets banker who can really help elaborate the equity story to potential market investors. And by the same token, I think if the CFO is an ex-investment banker who naturally you would hope is stronger in terms of that investor relations, stronger in terms of driving the equity story to the markets, that he or she would be supported by a phenomenal chief accounting officer that covers off those technical aspects. So for us, it's a deeper dive into what that team can deliver. And I think it removes the onus away from thinking exclusively about what the CFO themselves need to look like. So from our perspective, one of the things that we see an awful lot of at the moment in the trade press, and actually, frankly, a lot more in the chatter of our CFOs that we work with who are getting approached a pre-IPO round of financing. I'm going to ask a stupid question, Mike. What is pre-IPO financing rounds, and what does it mean to you? Because it doesn't feel vanilla as it should be, maybe.
I'm laughing only because that is so not a stupid question, in that actually there is no such thing as a pre-IPO financing round, in that it's really just a term which is bandied around for companies raising late-stage finance when one of the next steps for them might be an IPO. That's not strictly always true. There are definitely pre-IPO financings we work on which are definitively designed as part of the 3 to 6 month runway to a planned IPO. And we have certainly seen that and are working on several of those at the moment. And the economic and the fiscal terms of those investments are very directly aligned to the IPO outcome, typically. But an awful lot of these financings are just another form of late-stage private financing, often followed by a second pre-IPO late-stage financing. And I think picking up on what you said, the important thing from our perspective is to have a senior leadership team, particularly on the financial and, if I may put it this way, strategic side, who are agile enough to react to what can be some quite dramatic developments in the market. And what I mean by that is that we might be working on a growth stage financing and suddenly find that overnight that translates into an M&A sales process because a buyer has come in to interrupt the process. Or these days we are seeing the wonderful world of SPACs, where a SPAC might approach the company for what at one level feels like an acquisition of the company, but in reality is an opportunity for that company to go public via the back door and in an extremely compressed timetable. So you need a very smart, agile team, particularly finance team, to deliver on those dynamics. So I think the market is throwing up some very unique challenges, but equally some very unique opportunities. So John, as we come towards the end of this conversation, what would be your parting words of advice to companies facing these challenges and opportunities that I refer to? If there are maybe 3 things a fast-growing tech company should be doing now to prepare themselves for what is to come, what would you say they are?
A cheat sheet to success. Yeah, it's a good question. I think the first one undoubtedly is just be decisive in the market when it comes to hiring. We talked about the fact that there is a disconnect between supply and demand. There is undoubtedly wider opportunities for CFOs across all life cycle of businesses now. So I think actually the days of running sort of 3 to 6 month or 6 month processes and getting to a short list of 5 or 6 people, etc. 6 months is suddenly a long time in a company's life cycle. So to quote a great investor actually that spoke just recently, said hiring CFO now it feels a little bit like hiring an engineer in the Bay Area. Everyone you meet that is above bar, go to hire. And so from our perspective, definitely act decisively. I think that's something we've seen, and the great founders have done that recently with us, and it certainly turns the market in their favor. The second thing, I think, which is a slower burn, but is something which is starting to develop, is think about board composition well ahead of a transaction. I think sometimes we've seen trends where board composition, and by board we mean ahead of Remco, ahead of the audit committee, but critically actually what you get there is an experienced senior financial leader that can support a non-capital markets focused financial leader through that process. And the longer ahead of a timeline you can do that, hopefully the greater success should be. And the third piece that we've had increasing success actually as a firm. One of the positives of COVID is that we've seen more and more companies become quite genuinely remote first. In that instance, it opens up the US. If you're a European founder and you're certainly really considering actually driving your business towards a remote first model, there is naturally a much greater depth of talent from a CFO perspective, and indeed across the C-suite in the US that have been through this journey before, that's seen this journey. So certainly consider that. And we've seen many companies in Europe turning that to their favor. But those are the three definite cheat sheets that we'd sit and have that conversation with founders and funds alike. And back at you. I mean, for you, what are the three things you'd advise founders and funds alike?
Well, I guess if I was talking to a founder, I would be saying, are your interests as founders aligned with those of your investors? You may want to exit later. You may want to grow the company longer. You may well be under pressure from your investors who've got to return money to their LPs. And those two interests can start to get out of line with each other as you grow. But there are opportunities for secondary sales now to provide liquidity to earlier stage shareholders, and those we're seeing increasingly taken advantage of. Secondly, in the context of your particular business, how do you best realize value? Is it in the public markets, or is it actually through a combination with, say, a big tech buyer? And thirdly, I guess, drawing on a few of the things we've been talking about today, John, I'd say always be prepared. The timelines can be fantastically quick these days, as we've been saying. There's nothing worse than finding yourself in the exit chute without being properly prepared. So on that note, let me say it's been an absolute pleasure speaking with you today, John. Thank you very much for joining us.
Well, thanks again for the invitation, Mike. Really good conversation.
Thank you for listening to this episode in our Connected with Latham podcast series. You can subscribe and listen to new and archived episodes of Latham's podcasts on lw.com, Apple Podcasts, Google Podcasts, Spotify, or anywhere else you happen to listen to podcasts. If you'd like more information about the topics in this particular podcast, please just email us from the links located in the show description. And all that remains for me to say is we hope you'll join us again next time. Thank you.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 885 3rd Avenue, New York, New York, 10022-4834. Phone number 1-212-906-1200.